quick introduction. So Baderin Tejuoso, I'm senior executive on the venture capital team at UK Private Capital. So we are the industry trade body representing venture capital, private equity, private debt, venture debt, private credit, and everything sort of in that nexus. And with me, I have Michael.
Good morning, everyone, or afternoon, actually. So I am Michael. I'm the head of the UK for a firm called Allocator One or Infra One, depending on which side of the business we're talking about. Allocator One, we invest in emerging fund managers. We've got our own fund of funds, Fund Ones, Fund Twos, and Fund Threes. Infra One is the side where we work with fund managers to set their fund up, operational, regulatory, that kind of stuff. So hence why I've ended up sitting on this panel with Baderin.
Yeah, so what might make sense for this session is for us to sort of quickly whip through a couple of data points just to sort of frame the conversation and get to depths with the sort of ecosystem that we're operating in. So, and then Michael and I have a sort of honest and frank conversation about essentially what it means to be an emerging manager in this sort of turn of the market, and then open up to questions which we're very eager to get to. So just very quickly, obviously, I've done a little bit of the intro to UK Private Capital and who we are. Now looking at sort of the global venture outlook, we see obviously the general trend. So if we're looking at global equity investments, which is of course all equity going into, all equity investments being made globally, which is obviously venture capital, but also sort of CVCs and venture debt, which VC sort of crowds in, we're seeing a slight sort of creep up. But what's interesting is obviously the number of deals are going down, which we'll get into when Michael and I discuss a little bit later. But when looking at venture capital specifically, we're seeing a decline in sort of the fundraising globally. And this is for a myriad of reasons. Obviously, there's a sort of post-COVID hangover that we're seeing in the market, and also 2025, although we're seeing it picking up in real terms from a fundraising perspective, actually, because a lot of the large sort of managers raised in 24, we're seeing that snapshot is mainly looking at sort of at the specialist and emerging end, which again, we'll get into a little bit later. Yeah, so what we're seeing now is obviously AI in the fast lane. About a third of now all VC investments are largely predicated on AI, and we've stopped looking at AI as a vertical, and now it's sort of a horizontal that sits right across almost every deal that you're seeing these days. Fewer deals being done, and this is on a global level as well as on a UK level, which we'll get to shortly. But what that really says to us is post-COVID, we're seeing sort of a clearer idea coming in the minds of VCs, which similar to LPs, but to VCs in terms of who the real winners are. And what that means is there's more competitive rounds for the best deals and fewer sort of just what might have been called a spray and pray approach, which had been in the market a little bit more prior. Now looking at venture capital in the UK specifically, pleased to see the UK is still doing very well from a VC perspective, specifically when you contrast that with the European markets, which again, you see that UK companies raised more investment than sort of Germany, France, Switzerland, and the Netherlands combined in 2025, which speaks volumes as to the quality of companies we have here and also the level of just activity that's going on in this ecosystem. Yeah, so equity investments into UK, as I mentioned, still sort of steady in terms of overall volume, but we're seeing fewer deals being done, which is very interesting, again, as I mentioned, because it's all about sort of finding the real winners and having more competitive rounds at that stage of the market. We're seeing, again, 2024, we had the big funds going into the market, sort of index Baderin, raising billion-dollar funds. So when you take that out, it's about on par for the last 3 years in terms of the fundraising. The 2 billion cut really speaks to sort of specialist managers and emerging sort of VCs, which will be of interest, of course. AI being an all-time high, we're seeing just that puts it into terms in terms of just how much sort of startup activity is really going on at the AI end of the market. Yeah, so seed, typically the UK does really well, pre-seed, seed. when we get to around the 50 million mark in terms of ticket sizes, then we see sort of the broader sort of global capital coming in from sort of the US, Canada, a lot of the Australian pension funds crowd in as well. But then on a VC level, we're seeing sort of seed camp MMC concepts, for example, backing some of the biggest sort of household names, 11 Labs and the rest of them at the early stage. But so when you get to the sort of Series A, then we see the Sequoias, the Google Ventures, and the rest sort of picking that up. And what that means in real time is obviously a lot of that value is being exported, which we can get into if that's of interest. And this just sort of shows a few of the players in the market at the moment. So what does this tell us? The UK investment VC sort of landscape is very resilient. It's doing a really good job, and it's again the third largest VC ecosystem in the world, behind only the US and China for perspective. So there's a lot of good going on, and there's a lot of sort of areas where we can feed into that. The government is obviously pushing heavily on this. We see sort of sovereign AI announced of recent times, and also the British Business Bank. So they've sort of put out a range of programs which are in the market now since sort of April of this year. Of interest would be the 400 million sort of pot of money in the Investors Pathways program, which again is sort of aimed at bringing money to emerging managers actually, and making sure that we're creating more micro funds. And this is obviously really going to be really good for the UK's ecosystem, and we're looking forward to sort of seeing how that develops. And all of this is an interest to sort of close the domestic capital gap, which again, if you look at this sort of this illustration, it sort of shows where the different pots of money come from into UK venture managers, which is of interest. And the whole drive there is now bringing in more domestic institutional capital. But of course, we see that a lot of the capital might be at present is coming from the banks, family offices, funds of funds, and just in what proportions. But interestingly, this sort of holds up for emerging managers and is pretty consistent with what you see at the larger end. And it's all about now expanding the size of that and getting the overall capital in here, and also making sure that that's then filtering through to the right parts of the market. This is obviously all about the Mansion House reforms, and again, expanding that pool of institutional capital. Yeah, so again, a large part of the thinking, obviously now in the run-up to the budget, is thinking about how can we actually get the right expertise and expand that pool of already really good sort of companies that we're seeing here, driven by, of course, our really good sort of educational system and all the universities producing a high level of startups at the sort of pre-seed, seed level. And then it's all about the exited founders who come out on the other side, getting them to redeploy that capital back into the market, and also to make sure that their expertise isn't lost as well. So that's where the scale-up reinvestment relief comes in, which happy to speak to a little bit later. And now I think Michael and I are going to have a broader discussion on what needs to change. Obviously, diversified VC models, we're looking to bring that in, new exit routes, more capital, lower barriers to entry, and at which point I'm going to sit down and have a conversation with Michael. So Michael, what needs to change?
Thank you. First of all, to give you a little bit of background about what I do, basically every day I just talk to emerging fund managers, which is a lot of fun. I think there's still a tendency for fund managers to underestimate how difficult it is to raise your first fund. I think they have a tendency to think, 12 months and they hit their targets, like it's a slog. And I think there's also a concept that is a struggle in the UK where you get to this position, I always think of the Spider-Man meme, nerdy, but where everyone points at each other, right? Like no LP wants to be the first to jump in on the first time fund manager fund. And you end up in this situation where their fundraising journey takes so long because everyone has that same, approach of, I don't want to be the first to jump. Largely though, I think the emerging fund manager market is very positive. Like we as an LP see something like 1,500 applications a year from fund managers in the first, second, pushing maybe into the third time fund manager bucket. We've got a very broad strategy, so provided you sit in that, then we'll probably consider it. So that is global, but I think it just shows there is a real demand for this segment. I also think generally that emerging fund managers serve a real niche that's needed. The massive major funds, the Sequoias of the world, that they can't really go in on a pre-seed. They can't go in on a seed. The specialist micro funds of the emerging fund managers, like they fill this gap of the very early stage, more opportunistic investments, and I think that's hugely beneficial for the UK. I think it's hugely beneficial for Europe. Like we see lots of deals in both across the kind of ecosystem. But yeah, just as an intro, that's my sense.
Yeah, I'm very much inclined to agree with all of that. And just from what we said as well, sort of looking from a returns perspective, we see that actually a lot of fund managers in that first fund, the sort of returns that come from that are sort of astronomical versus sort of the Sequoias and the rest of them, which have very steady returns. But again, it's funds of that size, it's very hard to sort of double the fund versus when you raise your first fund, you're seeing sort of 5x outcomes, which is very promising to see. But I think it's very interesting when it comes into the sort of TVPI, DPI discussion, right? And sort of now the sort of backdrop of post-COVID environment, you're really thinking a lot of LPs, which Michael, I'm sure you can speak to, are thinking about when am I going to get my money back? That's what the whole game is. So as an emerging manager coming in, how do you answer that question?
So my sense and I feel like I've vicariously lived these journeys with these fund managers. My sense actually is that the first close generally comes from your first, second degree networks. So I always encourage the fund managers to really lean heavily into your network. Like the presentation earlier, someone mentioned 50% institutional, 50% family office for your first fund, and I thought, fuck. I thought every fund manager will bite your arm off that I talk to have a 50% institutional base. Like, it's very unusual. I think even with the BBB, they had 140 or so applications, I hear. Maybe they backed 10. It still doesn't really do much to move the dial. So conversations around DPI, etc. I think particularly for your first close, what you're trying to convince them of is you as an individual. Yeah. As a solo GP, you say, this is my specialist background. I've spent my last 20 years working in X industry, now invested in this X industry. These are all my fabulous contacts. These are all the fabulous portfolio companies. You sell them a little bit on your edge, and your edge is that you've lived it and you've proved it. And actually, because of your first close rounds typically coming from your networks, they tend to be less sophisticated in terms of understanding the kind of VC return model. So talking about DPI, etc., like they don't necessarily get that. They just think, oh shit, like deep tech sounds really interesting, or AI sounds interesting, or dual use sounds interesting. And they back you as an individual. And a big thing that actually I was talking to, I don't know who she is, there was a lady called Laura earlier about brand, and I think brand in emerging fund managers is hugely important, perhaps more so than conversations around DPI, because if you take a Sequoia of the world, and I'm very steadfast on this view, you could take a Sequoia of the world and you could almost insert any individual fund manager and Sequoia would still raise that fund. For a first-time fund, solo GP, like you are what they're backing. So you and your brand and how you portray yourself and your narratives and how you come out on LinkedIn, like that for me, I feel like is more of a driver and of an assistance to help you raise in that. Yes, there's an element of having institutional LPs, like that they have different needs and expectations, but I actually find that most of the time it's kind of high net worths in your network that people close on.
Yeah, absolutely. I'd say right now it's just all about really being clear about what is your right to win as an emerging manager. You're coming into the market and it's typically been seen as very crowded. It's hard for existing investors with good returns to go back into the market and raise capital. So it's always going to be very foundational to be able to say, okay, this is the background I come into, this is my specialist lens, and this is how I'm going to win deals and come into these crowded deals. We're seeing a lot of sort of interesting models where because of your technical expertise, for example, or your deep moats from your lens, you're able to come into some of the most competitive deals, and a lot of the bigger players are going to say, we're going to invest, but actually we want this specialist manager to come in, just because, again, of the technical lens, and that's really sort of important coming in. I think another sort of lens to look at this through, and Michael, will be good to sort of get your views on this, but with LPs, how far developed are you thinking the shift is coming from the sort of way LPs were looking at investing into the market pre-2020, 2021, and now in this market turn as well?
I think it's improving. My sense is that there's maybe more LPs looking to deploy, but there's also more VCs looking to raise, right? So it doesn't necessarily address the imbalance. Like, there's always more VCs walking around looking to raise from LPs than there are LPs looking to deploy, and it means LPs can be incredibly selective. So, I think to an extent, you're right. Like, they're all specialist fund managers, and I think it really lends itself for emerging fund managers. Their edge is that they have more value add to these portfolio companies, right? Like, I've seen it with some of the fund managers we've backed and that we work with, where their kind of smaller ticket has been taken by the portfolio company against one of the larger VCs, because frankly, their value add and their background is more so than just the brand name of having that VC on their table, which I think is a very interesting dynamic. But, generally speaking, fundraising is still hard. And I think, if you look at the UK versus Europe, yes, the BBB is there now, and I think their recent microfunds program, I think they moved very quickly to get to this stage. I've been really impressed, actually, and I think it's a real benefit to the UK. But you compare it to Europe's equivalent, like we're still very small players. Like, they can still deploy much more. They can still receive much more governmental money or institutional money than we can in the UK. So some fund managers we talk to in the UK are even like, maybe I could set my fund up and go for EIF instead of the BBB, because there's just a bigger pot. There's bigger tickets from those guys. And then you have the conversation of, well, you're based in the UK, maybe stick with that. But yeah, like, I'm like the cynic of always telling you how hard it is, but it is hard. There is no easy ones.
Yeah, absolutely. And I'll just add, it sort of showed up in a bit of the data that I showed earlier, but if you see just how many different sort of LP structures there are and how many different types of investors you can speak to, then it's obviously worth thinking about that from the onset and also planning the journey, because, Michael, you would know the sort of fundraising aspects of things is never really done. After raising fund one, you sort of have one eye on where's fund two coming from. So starting those conversations early is always going to be the main thing, and also making sure that the LPs that are being approached, the mechanics of the investment work, right? Can they put in a check to a fund of your size? Having that sort of clear vision and articulation of why are you looking for a 50 million close or 100 million close, and how many companies are you going to invest in off the back of that? And also, how are you going to identify these companies? What is your right to win in that market? I think all of that sort of feeds into each other very strongly.
Yeah, I agree. And I actually think that's interesting, because one of the things I see sometimes is people come in and they'll say, I want to raise 100 million funds. I'm like, that's a pretty chunky solo GP fund to raise on your own.
Yeah.
And then you ask them what their strategy is, and you're like, actually, the model doesn't really make sense. Like, you're not really going to deploy 100 million into pre-seed and seed. So then this is an actual example. Then they came back, and I was like, your fund's probably double the size it needs to be. And then they came back and pitched for 50. But like, I think there is an element of like fund managers taking stuff that the way it's always been done and using that to try and carve in their emerging manager mindset. Like the idea of reserves, for example. I had a fund manager who was looking to raise a relatively small kind of 4 or 5 million fund and a reserve of 40%, because that's the way it's always done, 30-40%. And I was like, why don't you just flip your model and remove the reserves? Like, one, you're going to eat most of that in fees anyway, but remove the reserves. Just go all in on pre-seed, and you try and exit. Your whole sales pitch then becomes, we're going to do a fund where we try and get you the DPI quicker by not doing the follow-on rounds. And I think in the world of emerging fund managers, I think you've got to be scrappy, you've got to be creative, you've got to look at how you can, one, drive down costs, two, increase value, and three, persuade LPs that you're the fund that they should back.
Yeah. I think, conscious, how much time do we have for questions left? Okay, nice. Because in a minute, I think it'll be good for us to open up to get questions from you guys. But I think that's really what it is. Being very clear from the outset. What are you looking to do in the market? What are the check sizes? Who are you going to invest in? And then approaching the right LPs who see that vision and who can go along with you on that journey as well. Yeah, should we open up to some questions? Are there any questions in the audience? Yes.
Two.
Is that better? Yeah.
Yeah.
So, what are the types of things that or examples of emerging managers differentiating themselves to LPs that you can give? Currently, most venture capital, most VC firms are pretty vanilla and all do the same thing. So, what are the ways that you can differentiate yourselves to LPs to stand out?
Yeah, I think emerging fund managers are interesting, right? Because they don't necessarily have like the track record, the quote unquote track record to point towards. So quite often what we'll see, and Antonis is in the team and he'll probably see this too, is that they'll maybe do like a kind of few SPVs beforehand. Deals to show, they can be either SPVs or even warehouse deals, like relatively small tickets. And what they'll do is they'll use those 3, 4, 5 investments to say, look, here's like an example of the sorts of companies that like excite me, and here's where they're at now, and whether they're being warehoused into the fund or not, I think is slightly irrelevant. I think actually what it shows is from an LP perspective, like they're even going to look at those portfolio companies and think, shit, they're really cool. This guy's got something, we want to back him. What are they going to be like? Oh, I'm not that interested. But like that is one way of like differentiating yourself, because I think if you go in, you say, maybe if you have more of a limited like angel background as well, I think it's much harder. So anything where you can show that you've been in on the deals, and if you've been on deals that have like some big VCs alongside you, like even if you do a relatively small ticket and there's a big lead VC, like that's something interesting to point towards, because then they'll say, actually, here you are alongside EF, for example. Like that is one way that like LPs would probably look to distinguish your fund, because there's lots of emerging funds and you're all running relatively similar strategies. AI defense right now is definitely the two hot topics. So anything you can do to just make yourself stand out is worth it.
Yeah, I'd agree. I think the sort of 3 things that I've sort of seen are sort of the expertise, the track record, which you mentioned, and then also some interesting things around the structuring, actually. So on the I think on the expertise side, obviously, just looking at, okay, why, again, am I a specialist in life sciences? We obviously see emerging managers coming in with deeply technical backgrounds, PhDs, and obviously showing you've done a lot of thinking around the specific topic and having a really clear idea as to not just where the market is now, but also having a clear vision of where it's going to be in the next 5 to 10 years. I think we've seen some interesting fund structures, actually. So we see sort of you coming in with sort of a founder's liquidity angle as well, and looking for, okay, baking into the strategy. Another way we're going to be able to attract the best founders is going to be able to bake in mechanisms to return the capital back to the founders earlier. And then that obviously ties in with things like venture that we're seeing in the market, right? And just being a little bit reactive to different sensitivities in the market at the time. And I think all of that sort of comes together nicely for a quite compelling story when talking to LPs, and really just showing that you understand where the market is at now and being able to win the right deals as well.
We have time for 1 or 2 more, depending on the length of the question. Let's go.
Sorry, I'll be quick. You mentioned at the start the sort of Spider-Man meme with the different LPs. Just very quickly, how do you suggest managing that? Because that's the exact problem we've got, and it resonated really strongly. So anything on that would be good.
It's like ultimately LPs it's a relationship, right? Like the panel earlier was talking about use of AI, and I think AI and LP relationships is not a good idea. Like you just have to persuade, and if they're on the edge, you just have to keep nudging them and nudging them and nudging them. Like eventually someone has to give. And I think the ones that you find are most likely to come in on your first close, like honing on those guys. And the other thing I find is that being very ruthless on the LPs that aren't likely to invest, right? Like you're better off freeing up your time and theirs by being very ruthless on the LPs that are kind of just going through the motions and that probably aren't going to move the dial on your first close. But yeah, I don't think there is an easy answer. Like having an anchor LP is obviously the dream because that unlocks everything. But there are a few of them that do that. It's just persistence as far as I can see. So probably not the ideal answer, but it is just persistence.
Yeah, I think I'll just add to that. So an interesting thing we do at UK Private Capital is we go on the investor roadshow. So we take delegations of emerging managers as well as sort of more established managers to the different countries. So we go to the US, Asia, Middle East, and all the rest of it. And I think an interesting thing that comes off the back of that is a really good outlook on the culture as well. So when sort of relating with an LP, understand the culture that they come from and the way to relate, because often this shifts slightly across geographies, and obviously places like the Middle East, for example, we find it's more sort of important to really build that relationship. It's just a long-term relationship. You might start the conversation now, but they might come in at fund 2, 3, or 4. So it's good to keep it warm, and it's a personal business. It's less of it'll be curious for your take on this. I don't think AI can really help you manage these relationships. I think it just has to sort of be organic, right? And make sure that these are LPs who want to be honest. They just want to go along with you on that journey, and they understand what you're trying to achieve through a well-articulated investment thesis, and then are up for that sort of journey with you, yeah.
Has anyone got a really quick one? No? Yes?
If you've never done a roadshow and you happen to have some really good success as an emerging manager, what would be a good way to expose your sort of results or your portfolio to new LPs?
Did you say if you've never done a roadshow? Sorry, I didn't hear what.
No, so if you've not really done an extensive roadshow and like you just have like your first sort of thing, but yeah, you have some success, but you want to sort of expand or raise a new fund. What would be the best way to sort of architect a roadshow to demonstrate your expertise or like your portfolio?
Yeah, I mean, I always find these events very interesting, right? Like, you can walk around the room and there'll be lots of people, like also asking you to invest in them. So it's like it becomes a little bit circular. Like networking is hugely important. Like whether it's from a portfolio investment, like i.e. you're looking to find interesting companies. I think you just need to get yourself out there, right? You need to get yourself out there. You need to come along stuff. You need to meet people. Rely on your networks. Like roadshows help. Like doing stuff with these guys. And there's I always forget the name, the UK Department for Trade and Business, wherever it's outside. Yeah. Like they do these roadshows as well, and they're very big on taking a handful of managers, same as what these guys do. Like you kind of just need to try. Like again, I don't think there is a silver bullet, because I think if there was like the secret key, then everyone would raise their funds very easily. It's just, again, it goes back to persistence, really.
Yeah, there's a saying I quite like, which is a moving man meets his luck, right? Which means you just need to be sort of out there putting in the hours and really shaking hands and having the conversations. And a lot of the we find that a lot of the most meaningful relationships just come organically, and you might meet people in the most sort of serendipitous ways, and that sort of happens. And obviously, there's things you can do personally on the branding side, and obviously on the content side, being sure to sort of put out really clearly articulate what you're trying to achieve, and take people along on that journey with you. So at different stages, say how things are evolving, share the highs, the lows, and also just show how you think as well, which is a key thing that we're thinking, because when people really understand that, they're going to say, okay, yes, this is someone that I'm willing to go on this journey on and background, and they're more invested in that journey personally.
Cool. How insightful was that, everyone? Let's give a round of applause to our speakers. Thank you, guys.